Hi, everybody. Welcome back to 10 Minutes with Griffin. I'm your host, Griffin Bridgers. For today's episode 132, we're going to continue our series on estate planning calculations. We'll look at the series in total in a second and where we've gone and where we're proceeding. But first, we're going to dive into the subject matter for today, which is examples of life estate calculations, taking into account code sections 7520 and 2702. Now, what these examples will show are how you apply some of the calculations we've looked at in a prior episode if you don't have software available to do so, and if you do, how do you check the results from that software, and where do you apply that software as well. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. Now, here's a list of our episodes so far. We looked at valuing life estates or income interests, either over a single life or even over a term of years in episode 108. We moved on from there to a calculation of a single life annuity and also looked at some of the adjustment factors that come into play when you have an annuity or unitrust distribution that is distributed more frequently than annually. Now, episode 132, this episode is going to tie back into episode 108 and look at specific examples of how the calculations in episode 108 are applied using real life numbers and assumed numbers, but just for a single life estate, just because we don't have enough time to cover term of years as well. That'll be a separate episode, but let's move into some specific examples. So a lot of these facts are going to carry over across three examples, and we're going to start with this first example with a life estate gift from a grantor. So we have our client, Grant, who's the grantor of a trust. He puts $1 million into that trust in January of 2021. What this trust provides is a distribution of all income to Betty and nobody else for the rest of Betty's lifetime. Then at Betty's death, the remainder would go to Roger, the remainder beneficiary. So in this case, what happens is that Grant has gifted $1 million total, part of it to Betty and part of it to Roger. But we need to figure out how much is allocated to each of them for a variety of reasons. And with that, we can't just split it equally. We need to use actuarial calculations to determine the value of Betty's life estate and the value of Roger's remainder interest. And in order to get there, we need some certain facts to be collected from the client. So starting off, we're going to assume these facts, but these are items of information you would typically have to collect to carry out this calculation. Now, one, since Betty's the recipient of a life estate, we need to know her age at her nearest birthday because the value of Roger's interest is going to be dependent on Betty's life expectancy. So, Betty is 56 years old at her nearest birthday. We also need to know the 75/20 rate for the month that Grant transfers the life estate to Betty. And in this case, it's 0.6%. So, our calculation first will be to determine the appropriate IRS tables, and in this case, since we have a life estate involved, we're only going to use IRS Table S, which has single life factors. We're not worried about a term of years or anything like that. We just go to the single life factor table and don't worry also about annuities or unitrusts or any of those adjustment factors. For step 2, we need to find the appropriate section of Table S based on the 75/20 rate. Now, I'm going to do something I don't usually do and scroll over to an example of the IRS Table S that I've pulled up. And this shows you that there's different sections based on the 75/20 rate. So, jumping back to our slides, we see that the appropriate portion of the table with interest at 0.6% pertains to what factors apply at Betty's age of 56. And in this case, we can see bolded here, at age 56, Betty has a certain life estate factor and remainder interest factor that come into play. And those are going to carry over to the next step. For step 3, we determined a life estate factor of 0.13 and change and a remainder factor of 0.86 and change. And these add up to 1. And that's on purpose. Now, step 4 is going to be multiplying the appropriate factor by the gift amount to determine the gifts to Betty and to Roger, respectively. Now, with Betty's gift, first we multiply the $1 million in trust times the life estate factor to come up with a gift of $135,940 from Grant to Betty. Now, since this is a life estate, it would qualify as a present interest, so Grant could also apply his gift tax annual exclusion to that, so his taxable gift to Betty would actually just be $120,940 after you subtract that $15,000. But in Roger's case, the rest goes to him as a remainder interest gift, in this case $864,060. And since that remainder interest will be something Roger doesn't get until a point way in the future, it's a future interest gift, meaning Grant could not apply his $15,000 gift tax annual exclusion for this gift to Roger. Now, let's complicate things a bit. Let's assume that Betty herself wants to make a gift of her life estate. So it may be intentional, it may be accidental, but Betty, after 10 months of receiving the income from the trust, decides that she doesn't want that life estate interest. She wants to get rid of it. So she relinquishes it, and that causes the trust balance to immediately vest in Roger. So what are the gift tax consequences here? Well, in this case, since Grant has already made the transfer, there's no gift tax consequence to Grant. Instead, Betty is the one here relinquishing a life estate, so in the eyes of the IRS, she's treated as making a gift. Now, she could try to classify this as a disclaimer, but she'd fail on that account because, one, you have to make a disclaimer within 9 months of the original transfer, which isn't the case here. And she's presumably accepted benefits in the form of income, because it says she's received income from the trust. So you can't accept benefits to have a qualified disclaimer either. So this would be a gift from Betty to Roger. So our assumed facts are now that Betty is 57 years old at her nearest birthday and Roger's 13. Now we're going to assume hyperinflation here in 2021. We're going to assume the 75/20 rate increases to 3.2% for the month of transfer, November 2021. Now that's just made up. That doesn't reflect reality in any case. So if you're listening to this in November 2021, that is not an error. This was just an assumed fact back when I recorded this in January of 2021. And we're going to assume that the trust is now worth $1.1 million at the time of transfer. So what happens here? Well, we walk through the same steps. We find the appropriate IRS table, in this case Table S, because Betty is gifting a life estate. And we find the appropriate section based on a now increased 75/20 rate of 3.2%. And we find the appropriate life estate factor for Betty's age of 57, which I've bolded here. As you can see, it's gone up dramatically from Grant's gift that occurred 10 months ago. So in this case, the life estate factor will be 0.50325, which when multiplied by the value of the trust generates a $553,575 gift from Betty to Roger. So, depending on the form Roger receives this may be a gift of a present interest or it may not be. So typically, if the interest continues on for Roger in trust, it wouldn't be a gift of a present interest unless that trust is set up in a qualifying form. Typically, it would have to be in a life estate form or in a 2503C minors trust for Roger, which he'd qualify for here because he's only 13. Now, note again, this is a gift from Betty, so we're concerned with the $15,000 gift tax annual exclusion with respect to Betty. Now, if this had transferred outright to Roger as well, or in an UGMA or UTMA account, then that would have been a gift of a present interest from Betty. So the big picture here to keep in mind is that rising interest rates are going to increase the gift tax value of a retained life estate or a given life estate, even if it's relinquished down the road. So if Betty wants to do this, she needs to be conscious of the interest rate, and you as a practitioner need to be conscious of that as well, because she's got a huge gift here that was probably unnecessary. Now, finally, for example 3, we're going to look at what if Grant didn't give away that life estate? What if he kept it for himself? So instead, he put $1 million into this trust, and it provides that all income will be distributed distributed to Grant for his lifetime, and then at his death, the remainder would go to Roger. So how much is the gift to Roger here? So our assumed facts are going to be that Grant is 59 years old at his nearest birthday, Roger is still 12, and since this is January of 2021, the 75/20 rate is still 0.6%. Now, anytime you have a grantor retaining an interest in a trust, then step one in calculating the gift tax consequences will be to determine if the Chapter 14 rules apply. Those are code sections 2701 to 2704. And what those do is they require economic certainty to be applied to a grantor's retained interest in order to assign it a positive value. And if you fail, you get a zero value. So in this case, Code section 2702 applies. Now, what that has is special rules that look at this type of transfer as being a GRIT, a grantor retained income trust, and they view that as a spurious transfer in most cases. So, if Grant had any descendants, then Grant's life estate would be valued at zero, meaning that he would have made a gift of $1 million to Roger, and we need not go through any of the remainder interest or present interest factor calculations. And even more, once again, the gift to Roger would be a gift of a future interest, which wouldn't qualify for the gift tax annual exclusion. Now, what would Grant need to have done in order to get a positive valuation here? He would have needed to structure this as an annuity interest or unitrust interest under Code Section 2702 in order to avoid a zero value. Because in that case, there's a guaranteed return to Grant. He can't just waive his right to income to create a spurious retained life estate that he may not have any intent to ever economically benefit from. Now, there is a carve-out under Code Section 2702 and its regs, which still allow certain types of retained interest life estate forms of trust. So, for example, if Grant had no descendants and Roger was a nephew, then Grant could get a positive valuation for his retained GRIT interests. And if this had been a Cupert, Grant could have gotten a positive valuation for the retained Cupert interest as well. And in either one of those cases, we'd use the same typical calculation. We'd go to the appropriate IRS table, once again, Table S, since this is a life estate, look at the 75/20 rate of 0.6% and the relating subtable, and then find the appropriate life estate factor for Grant's age of 59. Now, in this case, the calculation's a bit different. It changes up, but really what we do in this case is we take the present value of Grant's retained interest, which is 0.12345 multiplied by $1 million, and then we subtract that from 1 million to determine the present value of the remainder that ultimately goes to Roger. But since that's such a rare case that you'd have this apply, we're not necessarily going to dive into that result in this calculation. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.